Good morning. Thank you for joining us for today's webinar on reducing your state tax liability, navigating apportionment rules. I'm Bob Sharon, partner and leader of the firm's tax practice, and I am pleased to introduce you to today's presenters. Tom Corey is a principal at Finnigan and director of the firm's state and local tax group. He has more than 30 years of experience. Tom has worked with clients in a broad array of industries and advises high net worth individuals with respect to both their personal and business, state and local tax matters. Alan Goldenberg is also a principal and a member of the state and local tax and tax controversy groups. He focuses on tax transactions, including structuring, advisory tax services, and tax controversies. Alan has more than 10 years of experience representing taxpayers before the IRS and local tax authorities. Finnigan is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry in all regions where we operate. Finnigan's State and Local Tax Services Group is dedicated to helping clients avoid pitfalls and maximize their tax position in a complex and evolving tax landscape. The goal of today's program is to help you understand the impact of complex apportionment rules on your overall tax liability and reduce your exposure to potentially significant penalties. At the conclusion of the webinar, we will attend to questions from our listeners. You can submit these questions throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to schedule time to speak with you on a one-on-one basis to better guide you on your particular situation. And for our listeners tuned in from New York, our next webinar will be held October 24th, where our state and local tax professionals will provide an overview of recent changes to New York City's commercial rent tax and a deep dive into New York State and New York City real estate transfer taxes. Now, at this time, I'm pleased to turn the presentation over to my colleague, Tom Corey, who will kick off the program.
Thank you, Bob, and thank everyone for joining us this morning. I'm here with Alan Goldenberg. We're about to start a presentation regarding one of the most complex areas in state and local taxation, that being how does a corporation that operates or business that operates in a number of different jurisdictions apportion their income among those jurisdictions. Alan, you want to kick it off?
Sure. So just to give you a broad overview of the topics we're going to cover in the presentation, we'll start off with the congressional constitutional framework of apportionment. We'll also then jump into the three factors that typically make up apportionment in the various states. We'll jump into property and payroll, which are becoming less of a concern. We'll focus a lot on the sales factor, and then we'll touch on some various other items, dealing with apportionment that we often see with our clients.
Well, we're keenly aware that the property and payroll factors are not as important since many of the states are going to a complete receipts factor. We do think it important that since some of the states still are using either a four-factor formula, we touch on the property and payroll factors.
So from a state and local tax perspective, apportionment probably is the one remaining opportunity for taxpayers to seek some tax savings, right? The nexus now is becoming much more widespread. We recently had the Wayfair decision, which was a sales tax case, though we are seeing some states trying to push that same logic and the ruling into the income tax realm as well. And in addition, you see a lot of states really expanding their tax bases. We're seeing a lot of income now being deemed business income, whereas in the past, there used to be a lot of play that could be done or planning with respect to non-business income. So really now the opportunity from a state tax perspective, and tax planning really boils down to apportionment, trying to, develop as much as we can the nowhere income to avoid as much state taxation as we can.
Alan, I think it's important that we note that a lot of states are moving away from that business, non-business income concept and trying to kind of reach their hands and grab as much of the income that used to be classified as non-business, reclassify it all as business income.
So in terms of the Constitution, state apportionment is really a due process issue. Due process is the minimal connection between the state and the taxpayer. And there have been a number of Supreme Court cases that have come down as states have continually changed their apportionment methods. But it's important to keep in mind that the Supreme Court has not ruled that one apportionment methodology is the right way of doing things. As long as there is a relationship, a rational relationship between the taxpayer and the taxing state, the Supreme Court has upheld many of the apportionment methodologies states use, and that's why you will see various states use multiple types of apportionment, as a way of trying to bring in as much tax dollars as they can. The way that the history of apportionment really began with states that were really going after manufacturing entities. There were railroads. We were looking more at the property factor being the important aspect of apportionment. But in really the mid-'80s and onwards, there was a shift in state apportionment more towards the sales factor. And the concept with that is that states can shift the taxing burden from in-state businesses, which tend to have higher property and payroll factors, to out-of-state businesses, which are more likely just to be selling into the state. Obviously, the out-of-state taxpayers, can't vote in local elections, so the states oftentimes try to raise revenue from out-of-state taxpayers versus in-state taxpayers, and that shift has really expanded, resulted in expansion of the sales factor to multiple factors, to either 2-time sales factor, 3-time sales factor. We've even seen 4-time sales factor, and then eventually the elimination of the property and payroll factors as well.
This was a tendency that started with states that had a high manufacturing presence. They basically did not want to punish their in-state companies by apportioning more revenue to the state because of the high payrolls and properties that they had there. And over the course of years, it went from a double receipts factor to triple, sometimes occasionally quadruple, but eventually we're seeing more and more states now moving totally to a receipts factor to take property and payroll out of the equation altogether.
So Tom, let's jump into the property factor for a few minutes here and kind of explain some of the ins and outs here with what goes into the factor.
The property factor, again, is becoming less and less important. However, as we've got on our slides here, it reflects invested capital. That includes owned or rented property, real and tangible property, obviously used or available for use by the business. Construction in progress only when the actual property is placed in service. The property has to be capable of producing kind of an older concept here, business income. Removal from the factor is, conversion to non-business income sales. Again, we're moving away from this business, non-business type concept, and it generally, in many cases, excludes intangibles. How they value the property is based on the book value or its depreciated original cost, its net tax basis, fair market value, Again, state statutes vary in these how they value, but almost all of them, when it comes to rental property, go with 8 times the annual rent. And basically, they equate that to being equivalent to the fair market value of the property. What are some of the issues? You've got some acquisition problems in reorganization, inventory methods. You've got property in transit. You've got property that's outside the country or out of jurisdictional, things like ships, airplanes, satellites, etc. There are a lot of issues with respect to the property factor. Fortunately, it's becoming less and less prevalent in the apportionment equations. Alan, payroll?
Yeah, so payroll also is becoming less important in many states, but nevertheless, because states do still use it to some extent, we'll just touch upon some items here briefly. What's included in the payroll factor are really all types of remunerations that are paid to employees. It does also include payments to leased employees. That's something a question that does come up from time to time. And it would also include payments to employees who did services that may be protected under Public Law 86-272, a concept of federal law that protects companies from being taxed in a state where their only in-state activities is really soliciting sales of tangible personal property. Some items that are excluded from the payroll factor include retirement plans, benefits, health insurance. That's not really considered active business payroll, and therefore is not included in the payroll factor.
Now we move on to the big one, which is the sales factor. Again, repeating what we said earlier, more and more states are, if they're not going to a total sales factor, they're going to a multiple of the sales factor within their equation. Okay, so it includes basically all your sales of property, if you're in a manufacturer, retailer, etc. Sales of tangible personal property, rental, leasing, licensing, or use of real, tangible, or intangible property, any sales of business type equipment as opposed to non-business. Again, more states are getting away from this business, non-business identification, but it's still out there in a number of them. Interest, service, carrying charges, commissions. It, in many cases, can exclude certain items that are occasional sales, incidental, treasury functions, bonds, loans, litigation awards, tax refunds, certain cases, discharge of indebtedness. And now, Alan, we get into more of the complex rules of determining how sales are placed among the various states. Alan?
Yeah, so oftentimes when it comes to the sales factor, we really need to determine what the sales are stemming from, whether it's a sale of tangible personal property, whether it's a sale of intangible items, or service revenue. And depending on the type of category the sales fall into, states have different methodologies to determine what amounts are included in the state's apportionment factor and what is excluded. So when it comes to tangible personal property, oftentimes that's the easiest type of property to source, and the general rule that's often used is what's called the destination rule, and that's where you assign the sale to the state where the property is delivered to or where it's shipped to. That's a pretty simple concept. You're shipping, widgets out of state A into state B. The widgets are received in state B. Those sales are then sourced for apportionment purposes to state B. Another option when it comes to tangible personal property that some states have shifted to is what's called dock sales. And that's where the buyer or the purchaser takes possession of those items at the dock or at the seller's location. So for example, we have here New York will apply the rule that since the buyer took possession in New York, those sales would be sourced to New York. Again, it's easier, that's an easier methodology to conceptualize. Other states still apply a destination-based rule if the seller knows that the purchaser is ultimately going to move those products elsewhere. You know, if their shipping labels are marked, you know, from state A to state B, and the purchaser comes into state A and picks up those items, the seller has knowledge that those items are going to then be delivered to state B. In a limited number of states, those sales would be sourced now to state B instead of state A under their dock sale rules.
In this drop shipment, we've got destination versus origin, obviously, with respect to the states. You can get into some significant audit issues with this if the auditors are sharp. And it gets into who bears the risk of loss during the shipment. Generally, if the owner bears the risk of loss, the purchaser bears the risk of loss during the shipment, it's more likely that it's going to be an origin state. If, in fact, the risk of loss is borne by the seller, it's during the shipment, it's more likely it's going to be a destination state.
And I think, Tom, that concept, you know, looking at the contract, seeing who bears the risk of loss, where title transfers, you know, whose insurance would cover any of that risk of loss is important because many states don't necessarily provide guidance as to how they treat, you know, dock sales, destination-based sales. So these are all factors that come into play when determining, you know, how best to source those tangible property sales.
Right. Alan, we're moving into some territory that can get very confusing here when we move on to what's known as the throwback area. And basically, throwback means that if the goods are shipped outside of the state to a jurisdiction where the seller is not taxable, they are thrown back to the origination state, into the numerator of that state, for purposes of apportioning receipts to that state. Taxable, when they define it, it's equal subject to state net income tax or jurisdiction to tax, but the particular state that it's being shipped to chooses not to tax. State may not have may not have an income tax. In that case, you know, the throwback wouldn't apply. The originator of this concept was our friends out in California, and they still have it. More and more states have jumped on board. We've got, you know, a concept called double throwback, which can get very confusing. Thank goodness it's not in too many places. The seller is not taxable in either the origin or destination state. The sale is thrown back to the location of where the sale was solicited. This applies to drop shipments in Wisconsin. Alan, you want to talk about throwout?
Well, so I'll get into throwout in a second, but you mentioned California. The reason we see this so much and so prevalent in California is the fact that California has the highest, you know, taxing state in the country. They also have many third-party warehouses. So a lot of items are you know, being manufactured overseas, being delivered in China, and orders being fulfilled out of China, out of California. And we discussed Public Law 86-272 and how taxpayers may not necessarily be taxable in the various other states around the country. So those sales oftentimes will have to be thrown back to California, which is obviously something that taxpayers do not like to hear due to the almost 13% tax rate that California has.
Let's very quickly, just to avoid confusion at all, explain Public Law 86-272 is a federal law that was passed, I believe, back in the late 1950s when the world was a different place. That said, if in fact all a multi-state business does is send in salespeople to solicit sales into another state, and those sales are shipped in from out of state, and the sales have to be approved by, the seller outside the state. That's not enough to give the selling company, the out-of-state selling company, taxable nexus into the receiving jurisdiction. Public Law 86-272. It actually takes precedence over state economic nexus rules and everything else, if that's all you've got. But the states look at this very, very strictly, and if any activities go beyond solicitation of sales, then, for instance, collecting a check from a customer, that is outside the ambit of Public Law 86-272, and that will throw the protection way off.
So Tom, using that concept, in some scenarios where we do have taxpayers selling out of, say, California because of the high taxing state into other states, and they may be protected under Public Law 86-272. One thought or consideration may be is to establish nexus beyond the limits of Public Law 86-272 in a particular state, thus to avoid the throwback rule of California.
Yeah, what Alan, I think, is saying, since California's tax rates are so high, and if sales have to be thrown back to California because the states that they're selling to, the seller is protected by 86-272, one of the ways to potentially save some money here is for the selling company to go beyond the activities of Public Law 86-72 into the receiving jurisdiction, such they may only tax at 5% as opposed to the much higher California tax.
Throwout rule. New Jersey used to have this until a few years ago. It has a similar effect to the throwback rule, except for the throwout rule, sales to non-nexus states are removed from the denominator. Rather than adding sales back into the numerator, sales are pulled out of the denominator. Again, it prevents the overweighting of sales to the origin state. Pretty much the same effect as the throwback rule, just instead of affecting the numerator of the apportionment, we're now focusing on the denominator. Another concept here that we briefly put a slide on. I don't think we're going to dive too much into this, but it's a matter of consistency when we're talking about throwback and throwout rules in states, and economic nexus. Economic nexus is becoming more prevalent in states, and that's where out-of-state taxpayers that may not have a physical presence in the state, but have a number of receipts that cross an arbitrary threshold set by the state will be deemed to have nexus. If the state does have that rule and also does have a throwback type rule, they have to be consistent in applying both those concepts to taxpayers selling out of the state. And there's been some rulings with California on this, which we refer to here. I would just also point out that 86-272 is still applicable in these scenarios, so there's a lot of moving parts here. If this is something that may affect your business, we can certainly discuss this after the presentation.
Alan, we're moving on to something that can be quite complex. The Joyce Finnigan rules. Basically, the names of these rules come from the cases. These are California cases that establish these concepts. And California, in its confusion, has switched from Joyce, I think, to Finnigan, and back to, what are they now, Joyce? Finnigan. They've gone like 3 or 4 times back between them. The Joyce rule is basically deals with combined group apportionment. In the particular entity is making the sale. Under Joyce, if the particular entity is making the sale, then it can be considered part of the combined group. If in Finnigan, if a combined group is making the sale, and that is what is necessary for the combined. So if you've got a situation where you've got a combined group making a sale, and you may not have a particular entity involved making the sale, doesn't matter. The entire apportionment is done on the combined group. Its implications, obviously, to inbound and outbound sales in the throwback concept can be very complex. Alan, you want to expand on that a little bit?
Yeah, so the way I tend to remember it is that the Joyce is the individual company, whereas Finnigan is the combined group. And it has to, do with unitary concept, but with respect to inbound sales, so a sale from state A into state B, we're focusing on state B. Then if you have a sale by a combined group into a Joyce state, when the individual member of the group does not have nexus in state B, then those sales are excluded from the combined group's state B apportionment. The flip side, the converse is true if it's a sale into a Finnigan state, because it's looking at the entire group, the unitary concept, all the individual entities are combined together, and therefore the sales of the combined group are included in state B's sales factor.
Outbound sales, we look at the other way. Sales by the combined group from a Joyce state to a state where the member does not have nexus in that state are included in the combined group's sales factor in the origin state. Remember, Joyce requires the individual company to have nexus into the receiving state. Since it does, in this situation, does not have nexus in that state, it gets thrown back into the combined group sales factor in the origin state. Sales by a combined group from a Finnigan state to a state where the member does not have nexus are excluded from the combined group sales factor in the origin state. We've got the reverse of that situation.
So what we've done actually on the next slide is provided you with a chart, a state map showing you the various state rules when it comes to Joyce and Finnigan. As Tom said, it's rather complex, and there are a lot of considerations involved. So I refer you to this, but certainly if there is any specific questions, something to deal with, we can touch upon that later on.
Next slide, we're moving on to sales of other than tangible personal property. And there's been a lot of movement in this area in terms of sourcing over the course of the last 5-6 years or so. Again, California was a leader in this regard, in the sense that basically the way, let's take services. Services generally all used to be sourced wherever the services were performed. The difference was there were certain states that said, hey, if a majority of the services were performed in this state, even though some of the other states had some services performed in them, then we want all of the receipts from the sale of those services sourced to this state. Other states had a basically percentage cost of performance methodology, meaning that, hey, if 20% of the services were sourced here, 30% were sourced in state, B, and 50% in another state, we only want the 20% of the receipts source of those services in our receipts factor. However, more and more of the states are following the lead now where they're going to market-based. Market-based is basically where, there are the various definitions of it, but in its simplest form, it's where the services are delivered. For instance, if you're delivering them over the internet, or the benefit is enjoyed. Various states have various languages in their state statutes, but in essence, in simplest way, it's even if we're talking about services that are performed in one state, and that state happens to be a cost of performance state, the state that they are selling into is a market state, you can have a situation where you're basically being subject to tax on those same services in two different states. Basically, that happens when the services are performed in a cost of performance state, which says, hey, we want those services, receipts from those services to be sourced to our state, and you're selling those services into a market-based state that says, hey, the customer's here, we're entitled to those receipts. The inverse of that can happen when you have a sale into, a cost of performance state from a state that is a market-based state. So there are situations where you can either have doubling of the receipts from those services, including in the factors, or you can have, in essence, nowhere income. Alan?
Yeah, so some of the issues, aside from being whipsawed, let's put it that way, from a cost of performance to a market-based state, that we also see is determining how to source benefits that are received in multiple states. Where do we source, sales that are sales from services that are ordered in one location, but maybe the billing address is in another location? Where are those benefits received? And probably what we see most often also is that states, many times there's different rules when it comes to sourcing service receipts for corporations, partnerships, and sole proprietorships. So while a state may put itself out there and say we're a market-based state, when you look at sole proprietorships, that might be more cost of performance-based analysis. So, various concepts get floated around there, quite regularly.
Alan, why don't you talk a little bit about New York, because it has a kind of a unique system that it's used. It started when it made some changes about 3 or 4 years ago to its corporate provisions, and frankly, Alan will explain further on it, but it treats pass-through entities differently than it treats corporations.
Yeah, so New York previously was, for corporations, was a cost of performance state pre-2015 corporate tax reform based upon the pro rata share of the services being performed in the state. That changed beginning of 2015, and corporations now are on a market-based sourcing, but that's only for corporations. When it comes to partnerships here, the regulations are pretty clear that all charges for services performed by an employee working out of the New York office are sourced to New York. So more towards the cost of performance, methodology. Other states in the area have followed suit with New York and are also changing over for corporations to market-based sourcing. New Jersey recently passed its updated fiscal year bill, and included in that is a change to market-based sourcing, beginning for tax years beginning after August of this year, and Pennsylvania has already made the shift to a single sales factor state.
Alan, I think New York, frankly, was a little worried about, shifting totally to market-based. We've got a lot of, major pass-through entities, investment and other things that are located in New York, and I think they wanted to see the impact of moving from cost of performance to market-based before they pull the trigger on everything.
Now, one of the other things New York has done with respect to its apportionment being only sales is they've now released a second iteration of draft regulations. They've done away, there's no concept of business income and non-business income when it comes to sales in New York. Rather, they have different baskets, different categories of income where those sales are thrown into and apportioned accordingly. The previous draft regulations had 9 different baskets. A couple months ago, New York came out with updated regulations that contain 11 baskets. We've put some of the big ones down here. The first one being tangible personal property, electricity, real property. That's fairly straightforward. We understand that that's a destination-based test, the location of the property. That's an easier one to do an analysis on. Similarly, when it comes to rentals and royalties, we look at where the property is being used, where it's being employed. However, when it comes to digital products and other types of services, that's where New York has really changed the way that methodology is done, both for businesses as well as individuals. It's important, I think, also to realize that included within some of these draft regulations were some points that, with regard to GILTI, a federal tax concept, and financial transactions, which we won't delve into as much, but those items are listed in the updated regulations.
Alan, one of the things I wanted to bring up is that New York City has gone to a market-based sourcing for corporations for purposes of its corporate-based tax, but they do not include the S corporations, even though New York City does not formally recognize for purposes of its corporate tax an S corporation. For purposes of sourcing, if you're a federal S corporation, you do not get to use market-based sourcing. You're still using the old cost of performance sourcing, whereas state for S corporation purposes is using, even though it's a pass-through entity, has changed over to use market-based sourcing in that case.
So just to give a very high-level overview of the draft regulations that New York has for sourcing of services, we put together this chart here for quick reference. New York previously had 4 categories, kind of a cascading test or hierarchy that was in effect, and those were items 2, 4, 5, and 6 here. But under the new regulations that came out, they added in some additional items and some additional requirements. I just want to point out that, items 1A and 1B are rather straightforward. 1A being the in-person services, as I mentioned, the tangible property we can, certainly source to the location of receipt. 1B is more of an application to hedge funds, but the rest of revenues from services really focusing on items 2 through 7. And item 2, the old number 1 for New York purposes was where the receipt of the benefit is. Now what New York has done actually is bifurcated businesses and individuals. For businesses, there's a requirement for those that have less than 250 customers to do a reasonable customer inquiry and to see where the receipt of the benefit of that service is received. For individual customers, however, you can rely on the billing address of those customers. The next, if you can't make that determination, the next level down is a reasonable approximation. And one thing that was brought back in this test is the population approach. Though previously New York had disallowed the use of a population approach under the first draft regulations, they've now put that back in. And Tom and I, in our early years, have had some success in New York audits when we've sourced receipts from intangible income based on the population approach. We've got no changes on certain audits for that. So it's nice to see that they've at least brought that back into the draft regulations. We'll just flip to the next slide here for digital products. This works in a similar kind of concept as with the service revenue. Obviously there's nothing that relates to hedge funds, but it's a lot of the same detail that's included in terms of the reasonable business inquiries, depending on the number of customers you have, as well as less of a requirement when it comes to having individual customers.
The next slide is basically New York City. I've already mentioned that S corporations are not subject to market-based sourcing, and it's important to realize for purposes of the unincorporated business tax, you've got partnerships that are still operating of the cost of performance. The old kind of methodology is still being used in that case.
We've provided here a cheat sheet slide, so to speak, on the sales factor sourcing rules of services in the various states. Just note this is primarily from the perspective of corporate taxpayers, but it's nevertheless, it's just a nice quick reference for you and your businesses.
You should know that, you know, these rules are changing very rapidly. We're having more and more states move to a market-based approach. So while this is, we're confident this is accurate today, you know, in 6 months, it could look like somewhat of a different landscape.
So the home stretch here, we'll just touch upon some various other apportionment items that come up from time to time. One is the concept of alternative apportionment. Most states have provisions that allow taxpayers to request a different apportionment methodology if the standard formula doesn't fairly represent the extent of their activities within a state. That does require pre-approval, so it's not something that when you're preparing or finalizing your tax return, you can change on the fly. It's something that does take a bit of planning and solicitation from the state. Another area of apportionment that states have are specialized industry apportionment rules. We see this often when it comes to transportation companies. Airline companies have this. We've dealt with this when it comes to TV, you know, broadcasting. Utilities have their own taxing rules. So if you do operate within those industries, understand that there are other apportionment rules that may be impacting your business.
We've got other apportionment stuff here. Basically, there's always been this question of how does a corporate partner calculate its portion profits of an underlying investment in a partnership? Does it do it on the entity level, or does it do it on the partner level? And this explains it with an example. Various states have various methodologies. You just have to be careful.
When it comes to individual businesses that operate in multiple states, and when I'm talking about individuals, I'm talking about you know, Schedule C businesses. Typically, you know, you may also see apportionment there as well. So it's something to keep in mind. Although, again, remember, states have different rules when it comes to corporations and partnerships and sole proprietorships. So we, you know, just a word of caution there when it comes to that. In addition, personal income tax rules apply the entity level apportionment. That concept comes into play when an individual receives a K-1. K-1 for an investment is not, you know, they're not all aggregated together. Rather, each K-1 investment is, you know, allocated or portioned on its own individually on the individual's return.
A sale of a pass-through entity interest, this provides some kind of a difficulty determining if the sale is business income or not. Again, more and more states are trying to push away from this concept of business income versus non-business income. Kind of the two keynote cases here are Allied Signal case and the Meade-Westvaco case. And the issue was there had been sales, whether those should be included in the apportionable income of the selling entities, since they were not really tied in to their overall business strategies. Okay, we're now open, I think. Thank you for listening. We're now open for any questions. We've got a schedule there with respect to the general apportionment factors and how the various states are currently approaching apportionment. but we're very happy to answer any questions we may have.
Okay, so one of the questions we have here that has come in is how do companies determine cost of performance among the various states? I understand it comes from the work that's performed, but how do we determine that? So oftentimes states don't necessarily provide clear guidance on that as to how exactly to determine what is the cost of performance in a particular state. So we typically try to use a reasonable methodology when it comes to that. We've used hours worked, days worked in a state. We've also had some companies that may have more senior people in a company working in another state and junior people working in one state. And we typically believe that the higher paid employees are likely to have more of an impact on a job or on the service that's ultimately being provided. And we've, basically done a pro rata approach based upon salaries as well. I think the key is that it has to be a reasonable methodology that's within your industry, within your business, that represents the service that you are providing ultimately to your customers.
We got another question here basically that is asking more and more states are moving to kind of an economic nexus format. Is there anything that protects a company from being subject to that economic nexus threshold? To be honest with you, respect to services, not really. With respect to sales of tangible personal property, there is as we mentioned before, Public Law 86-272. If in fact all you are doing is sending sales folks into the jurisdiction to solicit sales, and these have to be sales of tangible personal property. Also, the state's tax has to be based on net income. Public Law 86-272 does not apply to gross receipts type taxes. Things like, it also does not apply to things like the Ohio CAT, et cetera. If in fact you are just sending these people in to solicit sales, and the sales have to be approved outside the state, the sales are shipped into the state generally by common carrier, then that will protect the economic nexus, you from the economic threshold. So again, only applies to sales of tangible personal property.
Tom, we got a question here regarding apportionment in real estate companies and rental income, and how that applies to to that type of income, whether it is subject to apportionment or whether you can allocate those receipts.
I think that has to do again with this concept of if it's a real estate company and it's in the business of renting real estate properties in a variety of states, it's probably going to be a situation where it's going to be considered part of the business income. Again, more and more states are trying to expand that concept in terms of characterizing income. And if it's part of the business income of the totality of the business, then it would be considered to be a apportionable income among the various states in which the company has properties that it is receiving rental incomes from.
Okay, and I think with that, we're going to wrap up the presentation. Please feel free to contact us with any follow-up questions that you may have, and we appreciate you joining us on today's webinar.
Thank you so much for being with us, and please feel free to listen to our additional webinars coming up.